Happy Thursday, traders. It's 8:01 a.m. Chicago time on the 9th of May, 2019. This is episode number 1512. Thank you for being here. I want to first remind you that this is also being broadcast over Periscope in case you're on the run and need a smaller format. The problem with Periscope, of course, is the resolution is lower. And but it plays seamlessly off your Twitter feed and on your phone and so on. It may be hard to see the numbers on the chart, but as the broadcast starts, the Periscope link is tweeted out on my Twitter feed at twitter.com/futurestrader71.com, futurestrader71. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, we have a risk aversion, a risk off sentiment. The product that took the worst hit this morning is the DAX. DAX down 1.5%, 183 points, followed by the Euro stocks down 47 points or 1.36%. The Nasdaq follows with a drop of 97.5 points, 1.27%. The Russell's down 16.5 points, 1%, and the S&P's down about 30 points or 1%. And that's where that stands. The bonds are leading the pack up 19 ticks. The yen is strong, the dollar's off, and the 10-year notes up 11.5 ticks today. And that's where we stand. So risk off. The market has got the jitters. Tomorrow's the deadline for the U.S.-China trade deal. Risk aversion theme still has momentum as U.S.-China trade and Brexit talks look increasingly more vulnerable. That's what's likely driving us. So we have traded back through, excuse me, on the close yesterday. Sorry, I'm starting to get a sore throat. On the close yesterday, we traded back through the China announcement or the news, which had us taking off from 28.81, and we came right back to it and took that out in the afternoon. Yesterday was an inside day across most of the U.S. indices. Currently, the indices are pushing lows. The prior low for the session was 28.58 in the ES, and it's currently pushing 28.56 and a half, 28.56 and a quarter or so. Initial jobless claims came in higher than expected. PPI demand came in lower than expected, and that's how the ball rolls. Excuse me. Looking ahead, we have wholesale inventories at 10 Eastern. 10 Eastern. And we have Fed's Bostic at 10:45. The 30-year bond auction, we might want to pay attention to it. The 10-year note auction was really bad yesterday, and or was it yesterday? I think it was yesterday. So we want to pay attention to what we get for the 30-year bond auction. We have Fed's Evans at 115. And again, at any given point, a bomb can be dropped on the market in the form of a tweet or whatever, and pushing prices directionally for a moment, like we've seen over the last couple of days. So that's where we stand. As far as what was expected yesterday, we go into our review segment. I keep having to clear my throat. I apologize. Doing this day in, day out, sometimes I'm just not 100%. So anyway, yesterday, the primary expectation is a drift down towards the overnight low and then a push towards the overnight high, which was at 28.99.50. Expected an inside day. Secondary scenario is a push higher. Oh man. Secondary scenario is a push higher that goes into balance and then starts to fall and pushes us below 28.60 and starts tracking down into 28.45. That did not happen. Here's what took place. It's more scenario one than anything. I can actually show it on the Renko chart. We get a push up, a drift down. We were not able to take out the overnight low. We have a strong impulse up, which then sets us up for the long side. So we're looking for longs, and what do we get? So let me ask this question. Trading Futures with Anthony Crudele's video was released on Sunday or Monday. It's on my Twitter feed. He's pushed it out on his Twitter feed and so on. It's gotten pretty good distribution. How many of you watched the setup that I talked about, or how many of you are aware of this video? I talked about a specific setup, and we see it here. Impulse pullback, right? And then we see another impulse with a mid pullback for this segment. And then once we fail through, I'm looking for a short, but of course I wouldn't take this one because it's into the closing. It's into the closing range, and you're likely to get run over. But this right here is what I was talking about. The market consolidates. It has an impulse, pulls back to mid, and then we look for. Remember, with the micros, we're trading three contracts with the micros is what's recommended. 3 contracts is less than a third of the risk of 1 contract. On the ES, the first contract, I talked about this on this show. I mean, I laid out a lot on the show in addition to the Futures IO segment. I mean, if you didn't listen to them, I really encourage you to do so. The Futures IO one is linked in the description of this YouTube video. It is also on the Convergent Trading YouTube TraderByte page. TraderByte page, and I'm laying out really the details of what you might want to consider planning for. Everybody trades differently, but at least somebody's out there telling you, hey, consider all these pieces. And one of the key pieces I talk about is trading 3 micros. The first you take off for risk mitigation for 2 to 2.5 points. The second targets the impulse high on the setup. So you want to front run the impulse high, whatever that high was. In this case, it was 28.83 1/4. You want to front run that by about 2 ticks. And then the third is a runner, and you manage that however you like. You can aim for a fixed target, you can trail it, or you can bring your stop to break even wherever you got in around the mid and see how far it can run and manage it that way. I don't put any restrictions on the runner. It's up to you. Most people would probably prefer to just secure maybe another rotation, which is 6 points from the entry, and just close the trade and call it good. But this example right here, and there's one from yesterday, there's the day before, and so on, but we see it right here. The first impulse, pull back to mid, push, we get a higher high. There's usually a continuation to an impulse, although the ES hasn't been doing a good job of that. We get another impulse on the news right here, and we get a pullback, and there's the higher high. That's the continuation, and then from here you have the corrective move. Really textbook stuff. I mean, honestly, I'm not blowing smoke at you or trying to get you to buy anything. I'm simply telling you it's there for you to look at and to study. Don't trade anything that you didn't study. Don't take my word for anything or anyone else's. Make sure you run through a chart bar by bar and see how it applies, because the mid trade does not always apply. It's got certain parameters that are very, very important to it. Anyway, so that's what we had yesterday. You can see it was an inside day. This was the plan for scenario 1. Scenario 1 was looking to go to the overnight high, and yesterday actually failed to take out the overnight high or the low. That is what I call the overnight stat. One second. That is what I call the overnight stat. And the overnight stat historically, and those of you who are Convergent have access to this through our market stat sheets, which is a full detailed statistical report on various behaviors within many different products across the CME, Eurex, and so on, you know that it's like 97.5 to 98% probability that we're likely to take the overnight high and the overnight low or the overnight low during the day session. That was 28.99.50. Oops. That was 28.99.50, and it was, what was it? 28.68 something down here. One of those is likely to be taken out during the day session from the Globex session, and yesterday we could not do it. We could not do it. So yesterday fell into the 2% probability on that particular stat. Again, every stat looks historically, and the outcome of of today is 50-50 always. So the likelihood of a historical probability of two overnight stat days in a row is minuscule. It's like 0.03% over 2,500 days or some crazy thing like that. So I expect that tonight's overnight high or low to be challenged at some point during the day session. So that's the recap. So scenario one was the play, a drift, impulse, and then we never got the continuation to 2,900, sat sideways, and then we closed, we sold on the close and on really strong volume. The overall volume yesterday was okay, but when we go into the overnight session, now remember yesterday's overnight here, US overnight or extended hours, Globex hours, was really high. And then we came into the day session. So look at the overnight, 558,000 is about 4 to 5 times what we would consider to be common. Okay. And then we came in and we traded 1.44, expecting 1.1 million in the day session. Look at today. The overnight session is 436,000 traded so far. They're about 15 minutes till that number stops, which is heavy. So the expectation is we're likely to see some action on the open. We had an inside day yesterday. We're opening beneath yesterday's low, and we may go into imbalance to the downside. So that's important to see. The overnight session remained below the mid. Remember, the mid is this blue line right here. The bright line, the cyan line, is VWAP, and you can see the market coming back up to mid, unable, impulse, come back to mid, unable, impulse again, or continue again here. So you can see that setup kind of the structure in the overnight session is quite clean, in my opinion, a lot cleaner than what we've seen in the day session. We're just zigzagging our way down. Buyers are unable to hold prices and they're unable to take back any of the prices higher that we've been so eager to buy up. Remember, V bottoms all over the place recently. So we're heading into the April 1st gap. We haven't been here for quite some time, and that's how things are shaping up. One thing I wanted to show or share is the fundies chart. Where is it? Here it is. This is just looking at the cash, underlying cash, to see where we are. We're below the 20 simple moving average. We're approaching the 50 simple moving average on the SPX. I think we're at it or around it in the futures, and then the 200s at 27.75 below. You can see that the market's pretty muted. New highs, new 52-week highs and lows are quite suppressed. So the move down has not been really crazy, and the put call ratio has been pretty suppressed as well. Well within what we would call normal, which is right here, this shaded area, which is a first standard deviation. So that's where we are. Let's take a quick look at how we did on the futures. So here in the futures, the simple moving average on the 50 is 28.63. Now I don't use moving averages or anything like that to trigger trades or to do my homework or whatever. but I know many people do, and I use it in a larger time frame in on the daily and the weekly, as you see here, and we're approaching that number in this gap. So we're in this gap here from April 1st. We've been in a big micro composite area up here, and we're trading well below the point of control. This area, it's looking kind of weak. So that's where we are. What do we have for today? Since I've been yapping my mouth off here all morning, I'll let you guys get back to your opening routine, which I hope you have one, and to move on with your day. So where are we? We are way down here. So we're opening below the first volatility sigma band down, above the volatility sigma band down, and we're pushing into we're pushing into this gap zone. The low is 28.52. The gap mid is 28.48. We're gapping down. So the question today is, do we gap and go? Really important to be very, very attentive at the open. Do we gap and go? Meaning we open and put in a small wiggle and push lower, or do we revert back? Do we respond back? Okay, the point of control, the MC point of control is right up here for this region. It's at 2908. We're well below the 2900 now. So my expectation is to open, test down, push this overnight low, impulse up, consolidate for a bit, and then start to drift up. But overall, here's the problem. The problem is the trade talk, the trade talks expire tomorrow. Okay, and tariffs might kick in, and so we have almost like an FOMC announcement that's coming. Why do tariffs matter? Tariffs are essentially a tax on Americans if applied by the U.S. government. It's a tax on Americans that raises prices uh, on products that are coming in from the country that we have applied tariffs to. So now your plastic toy, your refrigerator, whatever, is going to cost more. And what that does is it makes the cost of everything higher, which eats into earnings because all these companies are manufacturing product in China. It also oppresses the Chinese balance of trade because now we want less of their stuff, but it's at the expense of the consumers here. And so what it acts like is it acts like inflation. That's what it does. It looks like inflation, feels like inflation. All of a sudden, things you want to buy that are produced by foreign entities, which most of our stuff is, a lot of our stuff is, we have inflation. So you might consider this almost like an FOMC, announcement that's pending. So the market's likely to revert, but it's likely to just spike up or spike down based on what's coming. So what does that mean for your scenarios? For our scenarios for today, it means that I'm expecting to have this auction the same way, just as normal. However, it's almost like an FOMC release that you're not aware of what the time of is. So we don't know what time it's going to be released, and at any point it could blow right through. And that's why it's important to have a good news feed that keeps you informed. CNBC, in my opinion, is not good enough. There's far too much delay. So find something. You could also go to ctnews.pro and check that out, or if you're a member of Convergent, it's included in your membership at a deep, deep, deep discount. And so to me, trading without a news feed is really troublesome. The secondary scenario reverts back to some degree, and then we get an impulse down and we have a runner that looks like an open test drive type of behavior, open test drive, and we start to really push to the lower end of the 2800s. We're likely to push down to 2835, 2812, and so on. And we start to push really, really much lower if bad news comes out. Now, both countries need to come to an agreement, so that's expected. But again, as a trader, you're protecting your capital. There's no point fighting news or fighting what looks like an impulse or a push, a strong push. Just get out, take your hit, and if you're over your limit, stop, because your primary goal, your primary job is to be here tomorrow. It's not today's trade, making today's trade work. That's not your primary objective. Your primary objective as a trader is to survive. We're gladiators. We're always protecting ourselves first. And then when we see the opportunity, the edge, the thing we're strong on, then we step up and attack. But your first job is to protect your account. Okay? Don't be stupid. Don't don't be stubborn. Don't say it'll come back. It always does. It's not worth it. So your goal is just to protect your account so you can come back today, because without it, without your account being protected, you're not going to come back. And it's game over. It's like getting killed in the arena as a gladiator. It's just done. If you are trading an account that's smaller than around $3,500 per contract, you should be trading the micros. You really should if you're trading US products. Okay. Good luck today. And I know I covered a lot. Good luck today. I'll catch you tomorrow. Be prepared.